Worldwide markets this week. Results show SA consumer improving. Renewable energy listing with a dividend yield of around 9%. Omnia piles of cash, but SARS issues. PGMs are moving. What's the best miner? And CrowdStrike. I'm Simon Brown. This is Worldwide Markets, episode 634 for 11 June. It's been recorded Tuesday afternoon. Worldwide Markets powered by Standard Bank Global Markets and Shift, the global money app, your go-to for travel, shopping, payments, and investments in the palm of your hand, all at the cheapest forex rates. Thanks to Standard Bank and Shift for supporting the show. So I want to kick off with that news. We saw results on Friday from the Fashini Group as well as from Mr Price. Those were the two that came out. I hold both of them, so to be clear around that. And what we're seeing, both of them were full year results. But in both cases, what they also did was they kind of split it up into H1, H2. And in both cases, they talk around H2 being a better period. In other words, the consumer is improving. This is to February, so it would have been, 4 months at the end of last year. And appreciate that the sort of March running through that first H1, we had elections, there was certainly uncertainty, there was all of that sort of mess going down. And what we then see is lower rates, lower inflation, and of course two-pot money. Load shedding, that's what it's called, largely also gone. So both of those clearly showing an improving consumer. And there's another step to it as well, is that clothing is relatively discretionary. There comes a point when you need clothes, but there's a lot, I think, in line before clothing, food, insurance, shelter, that sort of thing. So I think that it's a fairly good sign. Now, let's be very clear, it is relative. South African consumer is not by any stretch booming, but certainly they are looking in a better position. And this is not a surprise. I spoke about it in my webcast, Position Your Portfolio for 2025. I had largely expected it. I thought we would see it coming towards the tail end of last year, maybe mid-year and into this year, and so far we are. As I say, they're not booming. This is not the consumer in an absolute strong position, but it is a consumer in a much better position than they have been. It's been a tough many years for South African consumers. We've got two results. One this week, Thursday, Meet the Managers, the actively managed certificate managers. That's 11:30. We got two of them. I got to say, these have been totally fascinating. I have spent some time digging around the AMCs, but getting to hear each of the managers for 10, 15 minutes talk around their thinking and philosophies and the like really has helped me understand not just their AMC, but the differences between them. So that's this Thursday, 12th at 11:30. Next Thursday, we've got a power hour, gold, know when to hold it, know when to fold it. That is 5:30, either webcast or live in person. Digging into gold. I mean, when do you hold the physical metal? When do you hold the miners? When do you get out of either or both or perhaps neither? Standard Bank's got a structured product coming on theirs as well. What about that as a potential solution? You can find more information, justonelap.com/events. So the Omnia results that came out were actually quite good. And there are a couple of moving parts. So mining, very strong. Agri, doing okay. Chemicals, under pressure. Cost them about 100 million in restructuring. Not unsurprising. They've got a pile of cash on the balance sheet, another special dividend. I got to say, this has been one of the turnarounds since that rights issue. When was the rights issue? Early 2020. The stock was sub 10 Rand at the time. And sub 20 Rand, my bad. And it really has been a huge success in terms of that rights issue and ultimately returning money back to shareholders. If you'd followed your rights, you've almost got your $20 back, quite simply just in the dividends and special dividends that are being paid. Stock's not expensive, price earnings around 10.5, dividend yield of around 5%, both of those quite attractive. The one challenge that they have and they need to resolve is that they have a issue with SARS. And if I recall correctly, the CFO in the results presentation on Monday was saying, look, we don't know where it goes. If we lose, we will appeal. I hear what they're doing, but I got to say, I do think that there's surely there's a decent argument to say just settle it. I mean, if you know, find a way to somewhere just settle it. Current price is 73. There's only one analyst covering it. They say it's worth just over 90. That SARS certainly is an overhang. Now, for a lot of folks, they won't be worried. They'll be like, SARS, no problem. But there certainly is a world in which the SARS is a concern. The rights issue, as I say, back sub 20 in 2020. The stock had been massively struggling, and it's looking good again. I mean, there's been a couple of entry points. I don't own it. It's just... I get the importance of agri. I get the importance of mining. Chemicals, we know what the problems are there. I just really, it's a stock I struggle to really probably, I suppose, in truth, get very excited about. But something that is lighting up the screens and exciting folks are the PGMs. We've got rhodium moving. We've got platinum moving. 5-year chart on platinum. Platinum has finally cleared up to those May 2021 levels. The break has held. We might see some pullback around to 1100, but trading at around 1227 as I record on platinum is good. Palladium, not quite the same story, but definitely looking okay. It's hit that first resistance, going through it. Next resistance is a little over 1200, maybe 1235 or there's about. So certainly the white metals are finally looking good. And then rhodium. Now, rhodium's a weird beast. It's deeply illiquid. It's not much of a market. But even as rhodium is up at 6,000, way down from what was rhodium's highs, 30,000. But 6,000 is also a lot better than the sort of 4 and a bit, and at one point just 4 that they were getting. That will certainly help. This all then says, okay, so which is the preferred platinum miner? So it depends what you want. If you want the risk one, it's Sibanye-Stillwater. They're the most highly geared to that process. The chart has been running, bit of resistance at around this 30 odd. We might see some pullback. The boring one is Volterra. That used to be Anglo Platinum. This is the low-cost producer. This really is the very, very strong platinum producer in our market in terms of low cost, whereas we find that Sibanye is much more geared, also much more geared to the rhodium price, of course. Again, moving into a little bit of resistance overhead there. You can get any of them. I mean, we've also got the two, there's ETFs and ETNs on both platinum and palladium. And Plat's actually having the slightly better run. And then, of course, there is Theresa as well, which had been under significant pressure. They are all running. Theresa's at an interesting level. That sort of 20 is going to be quite difficult to get through. And then the one I'm missing is Northern Platinum Holdings. There they are. You can buy any. At the one extreme is your Sibanye, which has also got some gold, and that is your more risky because they're more geared, as well as because they're a higher producer, but they've also got a lot more palladium from their North American operations. Your less geared, going to be more boring, is your Volterra. I suppose the point is pick your fighter and see which one is most going to be exciting to you. Something that is interesting and new onto the JSE, Greencoat Renewables. So this is a AIM listed in London. They essentially... what they've got is they've got about 1.5 gigawatts of power that they then renewable, mostly onshore wind. They've also got a bit of solar as well in their stable. A couple of European countries, Ireland, places like that. They then obviously sell it, long-term contracts, typically 20-year contracts with annual increases, usually inflation listed. Nice business. Certainly a demand for power and demand for renewable power. So Greencoat Renewables, they're listed on the JSE this Monday. GRP is the code, although some brokers aren't doing so one of my platforms is not giving me the GRT code. We can go have a look here. They are instead, and then as I do that, I lose some connection. It is back. They are doing GCT on Iris, weirdly. Liquidity is an issue because it wasn't an IPO or anything. There was already obviously some holders out of the UK who can now sell it locally. We are seeing some traffic. I've got some bids in. Let's see if it gets hit. The traction obviously is in large part that renewable and the demand for renewable. What's also attractive is an 8.9% dividend yield. This is the sterling one I'm looking at this point in time. So nice dividend yield in euros, which is attractive as well. They will look to expand. The stock has been under a fair bit of pressure. They're going to, I mean, the PEs of 17, the forward PEs around 9. Price to book is 0.7. I quite like that. You're essentially buying a utility. You're buying it at a slight discount to book value. You get a nice dividend yield thrown into it. It is energy, which is important, and it is renewable, which I think is equally important. So I think this is a great looking stock. As I say, I've got some bids in. We'll see if they can get hit. It's very low liquid at this point in time. That will improve. Market cap's only £850 million. That's so in size, not massive, but decent enough. And what we will get is nice increases in dividends, not shooting out the light. Maybe 2, maybe 3% a year increases in dividends. They do seem to have stopped issuing new shares. They might have to issue more because they go and buy they don't want to build the power plants, the renewable energy plants. Their game is let's go and find someone who's built one, and then the builder basically then hands it over to them, and they manage the process of it. Very light management team. It's actually managed by Schroders Renewable, so it's outsiders because they're power stations. Really, there's not a heck of a lot to do there. CrowdStrike, a stock I own, a stock I quite like. Security, always going to be a biggie. They had results out. The results were good. Remember, they shut down the internet August of last year. There was a bug in one of their releases and it all just crumbled and nothing really worked. They moved on from that. They've got nice recurring revenue. What they do is they've got a dashboard. So they sell you 1 or 2, 3 different products, and then they try and sell you other security products. And once you're embedded, it is difficult to unembed. There are others in this space. CrowdStrike is by no senses immune, but what they do have is that they have that install base. They need to grow it. Make no mistake about that. Your metrics are crazy. Your forward PE is 120. Your price to book is 35. There is no dividend yield. Back to this week just off all-time highs, but pretty much back to those all-time highs. Here's what I don't like about CrowdStrike. They issue shares. Their share count since listing has gone from, call it 200 million to 250 million. That's a 25% issue of shares. That is diluting me. They've now announced a $1 billion share buyback. Market cap's 115 billion, so it's not significant. It's less than 1%. But they're buying back at massive highs. You're better off, I think, paying, instead of $1 billion, just give everyone a 4-cent dividend. I think that is a better spend of the money. But of course, part of that is you buy back shares, and then on the backside, you issue shares to staff. I couldn't find strong details around sort of how many shares they hold, how many shares they've been issuing, but it does bother me because in essence it's a non-cost in many senses, and I don't even like buying back the shares at record highs. The average price target is 470. The stock's a little below that. The low is 330. The high 550. The thing is, cybersecurity is, of course, going to be the big part of the future. Make no mistake about that whatsoever. Cybersecurity is going to matter. And it is the one industry which pretty much every year gets more complex and more risky. In other words, the demand for their products continually increases. As I say, there are many other in the space. They are one of but many players, and in fact, an ETF might be a decent look at it as well. But it is going to be in demand. It is going to be in continually increasing demand. And the key point is that once you've dropped in and you have, in essence, said, okay, cool, we've gone with CrowdStrike, you haven't got a lot of options in terms of plan Bs. Let's go have a quick look at some other bits and pieces out there. US dollar continuing to weaken, the index now down at 99. This has been obviously helping our rand a whole lot. People keep on saying, is it rand weakness? Is it dollar strength? It's actually bits of both, is my sense. We're now down at 1767. That's after 9 April when we were at 1992 or there's about. And I still think that 17 is probably on the cards. Certainly 1780 was the immediate target. We are through that. And when I say it's dollar weakness, but also some rand strength, that rand strength is we have been seeing some money flowing into our markets. We've seen our bonds improve a fair bit. This on the back of a couple of things. Obviously, people not liking the US, we'll look at that in a moment. But also, just quite simply, that the talk around a 3% inflation target has really got global markets quite interested in our market. It's good for bonds. We're seeing our bonds improving. The US 10-year continues to hover around the 4.5% level. We'll have a look at that in a moment. And then, of course, gold. Gold continues to be strong. I mean, trading 3,337 and 79 cents, just to make that tongue twister more. It continues to consolidate around the 32.15, 32.10 up to now about the 33.50 odd, with pops above that. And if we have a quick look at the US 10, 4.451, so a little better. It was 4.5 if memory serves on Monday, but it is still a fairly chunky level, and certainly of concern to authorities in America. That is not what you're looking to see. If we quickly scroll down, there we go. Here's the South African ones. So we've got a 5 year. Our 5 years down at 8.6, our 10 years down at 10.09, and our 30 at 11.125. And in all cases, they have been coming down. Interestingly, the Brazilian 10 years at just over 14. And for an age, Brazil was the junk status country that we would look at and say, but how come their debt is better than ours or cheaper than ours? That is no longer the case. Certainly, we are cheaper than them in terms of debt. But what we do have is that our debt is coming down quite nicely, particularly the 5 year, but all of them. And this means that so the current bonds that our government has issued, it makes no difference. But of course, they're constantly issuing new bonds every week, and it does make those new bonds cheaper and save us a little bit of interest. To be clear, I'm not saying that that debt is not the problem. It is, but it's not. When your bank phones you up and says, "Hey, you're paying less on your interest," that is always a nice feeling, and that's essentially what South Africa is getting at this point in time. We'll leave it there, a little short, but nonetheless, my name is Simon. We'll be back again next week. Remember those events. We've got the AMC Managers this Thursday at 11:30, webcast only. We've got gold, know when to hold it, know when to fold it. That is next Thursday, 5:30, either live at the Standard Bank head office or webcast, justonelap.com/events for more information. My name is Simon. We'll be back again next week. Until then, look after yourself, and if you can, look after somebody else as well. Cheers all.